Good morning, everybody. My name is Luca Testoni. I'm editor-in-chief of ETicaNews and ESG Business Review. It's a pleasure for me to be here today with Guido Giese, Executive Director, Core Equity Research at MSCI. I tried to translate this chart, and it's something that is similar to the mathematical brain of MSCI. So let me joke, Guido, but probably I'm not so far from the truth. Yes, and it's a pleasure to be here because I think that this interview, this talk that we are going to have, is something that is probably one of the most instructive and most formative sessions today. We are going to go deep inside what ESG means and what is ESG world. And it was a pleasure to have Mr. Guido with us 2 years ago in SALONE SRI 2018. Then we discussed about your previous research study. It was a foundation of ESG investing, and that was a pillar for your research last year. And now you published a follow-up of the study called Deconstructing Esg rating performance. What was the reason for publishing a follow-up study, Guido?
Yes, thank you for the question. Thank you for having me here today again. I still remember our session 2 years ago, where we actually presented the previous study. Let me just quickly share this. Can you see the screen? I just need to share the screen. Can you see it now?
I see it, but it's not a full screen image. Probably
now it's here, yes.
Yeah.
Yes. Okay. So 2 years ago, you're right, we published a study that was called Foundations of ESG Investing. It was actually published in the Journal of Portfolio Management. And the reason was that we found there is a huge confusion in the market about the question whether ESG is financially relevant, whether it's good or bad for performance. We found there were 2,000 studies on the topic. Most of them were backtesting, and you know how it is. You can always find a beautiful backtest, and you can always find an underperforming backtest. So in the previous study, we said, look, let's move away from backtesting. That doesn't solve the problem. If ESG has a financial value, we need to understand the fundamental reason for it, the economic reason for it. And that's what the previous study did. And basically, we used our life track of ESG ratings. We have ratings since 2006. Live, so no backfilling. We did a quintile analysis, so we compared the highest rated companies to the lowest rated companies, and we found 3 economic reasons or 3 economic transmission channels how ESG affected risk and performance. And the first transmission channel was we found that good rated companies outperformed low rated companies, but not only outperformance, we also found that their fundamentals were better, their earnings were better. The earning stability was better and the earnings growth was better. So the better stock performance was rooted in better earnings and better earnings growth. So there's a fundamental reason behind it. The second thing we found is that companies with good ratings, they were safer in terms of corporate risk. So what we did is we looked at how often do companies have a bad incident, like the Wirecard case in Germany or the Volkswagen case or Petrobras, there are lots of these cases. And we found that companies with good ratings, they were 3 times less likely to have such a case. So companies with good ratings were clearly less likely to suffer something really bad. And the third thing we found is that companies with good ratings, they are more crisis resilient. So when there's a shock in the market, like the COVID shock or the financial crisis or the European sovereign crisis, companies with good ratings that did better, even after controlling for other factors. So even if we take out low vol, value, size, momentum, there's still a difference. So this is what we found, the 3 economic reasons why good rated companies were better. But now the question was, okay, but where does it come from? Does it come from the E, from the S, from the G, from all of them? Because we have a rating model, right, which you see here. So we create this top level ESG rating from MSCI, but there are 37 ESG risk issues underneath. So we have environmental risks like carbon emissions, water stress. We have social risks like health and safety, data security, and we have corporate governance, of course. And in each industry, we do an industry-specific selection and weighting of the key issues. So we don't rate every company the same way. We focus on those risks that are relevant for the industry. So, for example, in the banking sector, a lot of weight is given to governance, right? Because the risk in banking is governance. In the energy sector, we give more weights to environmental issues like carbon emissions. So it's very industry specific. But the question is, of course, okay, but which parts of this rating model has been driving these economic improvements? So better earnings, lower risk figures. And these are the questions we got from clients, because we had clients reading our papers and they asked, well, some clients said, you know what, I believe it's all governance. All this financial relevance comes from governance, and the E and the S is just for decoration, right? Just to make it look green. But maybe, it's fair enough, the question. Or another client said, well, adding up E, S, and G, does that really make sense? Because ESG is so different, right? You're adding potatoes, apples, and bananas. Maybe we should just look at governance. This came back again. Just look at governance, and the E and S. Well, we're not sure about it. And so there were a lot of skeptical questions about, does it really make sense to aggregate ESG? Should we not just use governance, right? So this was the question. The new study was about answering these questions.
Yeah, it's very interesting, the transmission channel, the analysis on the back, and this way of, you call them banana and something other. It's very different than the E, the S, and ESG. But the question remains, it's really just a matter of governance that matters financially.
Yeah, exactly. And this is what we did a top-down research study where we first looked at the E, the S, and the G rating separately. So we basically reran the analysis, but for E, S, and G individually. So basically what we did, we quintiles again, the best rated E to the lowest rated E, the best rated G to the lowest rated G, the best rated S to the lowest rated S, and we compared risk and performance of these individual ones. And I show you here, let's start at performance. So here you see E, S, and G, the performance of the top rated versus the bottom rated for E, S, and G individual. So S is green, G is red, and E is yellow, and the total ESG is blue. And you see overall, actually all three have outperformed. So the top rated have outperformed the bottom rated in all three pillars. And we also did a factor attribution. So we checked whether there's a quality factor in there or a value factor. You find it in the paper. We did the full factor attribution. But we found there is a positive effect even after controlling for factors. Now, all three have outperformed. It is true that governance was a bit stronger than the others. So governance had performed a bit better than E and S. But so all three have shown outperformance, not just governance. But the interesting thing is the total ESG rating performed best. Total ESG rating performed better than G, better than E, better than S. And that is weird, because at the first glance, you would say, how is that possible? The total score is the aggregation of E, S, and G. So this chart tells us something like 1 + 1 + 1 = 5. And my math teacher would say, well, hold on a second, that can't be, right? 1 + 1 + 1 = 5. Well, how is that mathematically possible? There's only one way how this is mathematically possible. It's only possible because of the industry-specific weighting of E, S, and G in each industry. So our rating is not just adding E, S, and G up, so a third E, third S, third G. It's very industry-specific. So more governance, more weight is given to governance and financials, more weight is given to E in the energy sector. So only the industry-specific weighting can explain why the total rating is better. But we wanted to prove it. We wanted to give you the mathematical proof that the industry-specific weighting is what adds the value. And the way we did that, we said, okay, let's calculate the, in quotation mark, dumb ESG rating, which just takes a third E, a third S, a third G, everywhere, in every industry, right? And we compared the performance. And this is the performance. So here, blue, you see again the total ESG rating of MSCI. And then the yellow line is, if you do the dumb approach, a third E, a third S, a third G. And you see, yes, it doesn't perform that well. So the industry-specific weighting of E, S, and G has created large part of the outperformance. So there's a lot of value in the industry-specific weighting of E, S, and G. So you should never use the same weighting in the financial sector as the energy sector, because then you actually lose value. So aggregating ESG only makes sense if you do it in a very, very industry-specific way, really highlighting the key risks in each industry. So this is how we looked at the performance side. But then the transmission channels that we found also looked at the risk side. So I mentioned before, we found that companies with good ratings had a lower frequency of incidents, like a lower frequency of cases like Volkswagen or like Wirecard. But the question is, how do you prove that? Because if you cherry pick cases like Volkswagen or Wirecard, then you do cherry picking, right? But that's cherry picking is not research. So how do you prove that companies with good ratings are really less likely to suffer corporate specific risks? And the way we did that, we did the same as in the previous study. What we did is we just looked at how often do companies take a large stock drawdown. So we're not cherry picking names. We're not cherry picking Volkswagen and Petrobras. We take all the companies that took a large drawdown in the benchmark. And we don't care what caused it. When a company takes a large drawdown, something must have happened. We don't care what it is. We just look at how often do companies take drawdowns, and we compare the frequency of these drawdowns for the low-rated companies to the high-rated companies. It's a bit like credit ratings, where you compare default frequencies, right? How often do companies default? And you compare the frequencies over the credit ratings. We do the same here. And here in this chart, you see on the x-axis, we look at what drawdowns the companies take. So, for example, the 40% drawdown, 50% drawdown, 60% drawdown. And then we compare the frequency of the bad-rated companies to the good-rated companies. So, for example, if we see a ratio of 2.5, it means that the low-rated companies were 2.5 times more likely to suffer really bad drawdown that was caused by some corporate-specific incident. What is interesting here, the more you go into the tail of the distribution, you go to 50, 60, 70% drawdown, you see ESG has added more value. So the difference between the good rated and bad rated companies increases. So the bigger the risk that happened, the worse it was, the more ESG has added value. So ESG is a really good tail risk measure. The more you go into the tail of bad things happening, the more value ESG has added. The interesting thing here again is that the total ESG rating was best. So the blue line is the total rating, was the best predictor for risk. But all three pillars have added value, so the E, S, and G. But the total rating, again, has picked the right risks in each industry. It showed the best improvement of risk. So this is basically how we validated the rating methodology in terms of E, S, and G.
Yes, it's very interesting, and I have to say that it's really what I said before, a mathematical approach in what the ESG means, and we try to translate it in something that is understandable. And you find the formula for 1 + 1 + 1 = 5. It's very fine, but it's very, at the end, aggregation is the best. It's very interesting. Yeah. So it's not a matter of governance. It's something that's integrated ES in ESG. But the next step is it's about you look at individually E, S, and G from key risk issues.
Yes.
And what did you find in that?
Yes. The obvious question now is to go one level lower, because as I mentioned before, E, S, and G, they have this different key risks underneath, right? Like carbon emissions. And basically you can go through the different key risks. I'm just showing you, I mean, we have a lot more data in the paper. I just give you a condensed version because the data tables are very big. I'd give you a little condensed version of what we tested, but here, just to show you the most common risk, for example, carbon emissions, water stress, toxic emissions in the E pillar. Social risks are like health and safety, data privacy and security, or corporate governance. We have business ethics, corruption. And here again, we did the same thing. For each of these key issues, we grouped them in pillars. So the best rated, the lowest rated companies over the full life track of the rating. And we compared again performance, risk, fund, and so on. The same thing again. And we also looked at statistical significance of these differences. So this is what I showed here. The blue bars show you whether the performance and risks differences were statistically significant. Now, I don't want to bore you with T-stats. People in the audience who want to know exactly the formulas and statistical significance, they can dive in the paper, but I can tell you here, almost all the tests were statistically significant. So only the red ones here had low statistical significance. But let's not spend too much time on significance. Let's look at risk and performance. So once again, for each of these key issues, we checked, have the better rated companies shown better performance figures, and have the better rated companies on these key issues shown better risk figures. So we grouped them on both ways, risk and return. And this is actually the most important chart from the paper. It's also the most complex one, but it's actually not so complex. At the first glance, you think, oh, wow, this looks very complicated, but it's actually very simple. So the y-axis shows you the predictive power of these key issues for risk. So basically, we looked at whether good rated companies had a lower frequency of stock-specific risk than low-rated companies. So for example, look at business ethics. So business ethics is like corporate governance are the red dots, right? Business ethics is at a factor of 4. What does it mean? It means that companies with good business ethics were 4 times less likely to have something bad happening, like Wirecard or something, than companies with bad business ethics. So basically, good business ethics makes companies 4 times safer. 4 times safer. That's a lot. That's a lot. But business ethics did not create too much outperformance. So that's the x-axis. So business ethics is really what we called an event risk driver. It shows you how likely is a bad event, and it helps you to make safer portfolios, but it was not a big return driver. By contrast, the green dots are the environmental issues. For example, carbon emissions. Carbon emissions didn't help you much on the risk side. So whether you have good or bad carbon emissions, it didn't matter for your risk, but it mattered big time for your performance. Actually, good carbon emissions had the best outperformance from all key issues in the rating model. It even outperformed corporate governance. So what we found here is, well, actually, there are 2 types of ESG risks. There are ESG risks that materialize as events, like a scandal, a bribery, or a fraud. And that's what is measured by business ethics, anti-com practices. But then there are other risk factors that we call erosion risks. They don't happen on one day, but they happen slowly over time. So for example, if you're a company with bad carbon emissions, your stock price is very likely to suffer slowly over time. So there is 2 types of risks: event risks that materialize as a bribery scandal, and erosion risks that come slowly over time. And just to prove that to you, that there are some risks that go very slowly, we plotted here the outperformance of these erosion risk factors. So carbon emissions, water stress, these are risk factors that can hurt the stock price slowly over time. And you see exactly what's happening here. So we compared the good rated companies to the low rated companies in carbon emissions, water stress, and we see that slowly over time, the good rated companies, they accumulate outperformance, but it's slow moving. So good carbon emissions doesn't give you an outperformance effect over 2 months, but it does give you an outperformance effect over 7 years or 10 years. So these are what we call erosion risks. They happen slowly, but continuously, and you observe them over long periods of time. So this is one of the key observations. There are these event risks that are mainly measured by corporate governance, and these slow-moving erosion risks that are more measured by, that are more inherent in environmental risks. So this is what we found deep down at the individual level of these key risks.
Thank you. Thank you, Guido. I have to say that probably I need some time to study it, to really enter in your lesson today, because for me this is a sort of learning in what ESG could mean behind the screen. And thank you for driving us to this comprehension of individual ES and G issues. So at the end, the final question could be, okay, but what does this research tell us about the construction and the application of ESG rating in practice?
Yes, I think that's probably the most important question, because I think if you listen to the presentation, you might say, okay, that's all nice. And by the way, this study also appears in the Journal of Portfolio Management, which is an academic journal, next February. It's nice to write academic journals, but I mean, what can you do with it, right? I mean, can I earn money with this? You might ask. And the answer is yes, you can. It helps you to improve how you integrate ESG in portfolios, or how you build ESG ratings, right? And just to recap some of the key findings, we found that the aggregation of ESG has actually added value, which means if you just use governance in your portfolio, you might miss out on performance or on risk. So aggregating ES and G in a industry specific way can create better portfolios. But there's one thing to remember. We've observed these short-term event risks and long-term erosion risks that are in the rating model. And what can we learn from that? Or what are the lesson learned for integrating ESG into your portfolio? It basically means the following. If you want to integrate ESG considerations as a risk filter or performance filter in your portfolio, you need to have an understanding of your time horizon and how active you are. Why is that? Well, let's make two cases. The first case is, let's assume you are a very active portfolio manager. So you're a stock picker, you have a very focused portfolio, and you reshuffle the portfolio very often. You're very active. In that case, all you care about is event risk, because you hold a very concentrated portfolio. You don't want to be invested in Wirecard. You don't want to be invested in something that blows up. So if you're very active manager, very concentrated, you care about event risk. So you would focus more on the governance and the social factors, because they drive this event risk. And you don't care so much about the long-term erosion factors, because you reshuffle your portfolio anyway, right? So you don't have a long-term horizon. By contrast, if you're the second type, let's say you are a buy and hold investor and you're very, very diversified. Let's say you're a pension fund, you have a very broad portfolio, you hold your stocks for 20 years, then you probably don't care so much about event risk, because you're very diversified anyway. Then erosion risk is far more important. So then it's important that you're not invested in companies that can lose you money slowly over time, because over 20 years, that can be a lot of money that you're losing. So for long-term investor, you're more about the erosion risk. So it basically means, depending on what your time horizon is, you may focus more on the short-term event risks, or you focus more on the long-term governance risks. And last but not least, it's interesting that we found the almost identical results for fixed income. So 2 weeks ago, we published almost the identical study for corporate bonds. And here we found very similar results. We found this event risk type of behavior in corporate bonds. We found long-term differences in profitability and kind of erosion effects. So the same logic applies also for application of ESG ratings in corporate bonds for the same economic reasons, actually, that you have this short-term event risk, the long-term erosion risk. And for those of you who are interested, you find the different studies on our website for fixed income and for equities, so you can download them for free on our website.
Thank you very much. I already downloaded one of the two from the internet site, and I find it's really very interesting, and also because there is all the transcription. It's very, very useful for my understanding. Okay, Guido, yes, I repeat, this without doubt one of the most instructive and formative session of our day. I mean, Salone SRI 2020, as it was 2 years ago, and then we are at the time of the, I mean, goodbye I have to thank you for your ability also in convey complex mathematical issues and concepts and make them tangible as you did in the last slide, where you mentioned that there are different kind of investor, active or not active, or short-term and long-term. It could be very useful. And for my side, I think that it's okay with my questions. If you want to, I mean, to say something to close the section, we are at the end of this conference.
Yeah, no, thank you for having me. That was great. It was a pleasure to be here again, and I hope next time we can meet again in person in Milano, hopefully.
Yeah, of course, it could be a pleasure. Okay, thank you very much.
Thank you very much.
Physically in Milano, or maybe who knows, somewhere.
Somewhere else, yes.
Somewhere else, and thank you very much.
Thank you for having me.
Thank you for our. Okay, bye. But I suppose that we are out now. Regia, sorry. Okay, I suppose that we have closed. Thank you again.
Thank you. Yeah, it was a pleasure. Thank you. Bye.